Hello there, everyone, and welcome to the Final Bar. It's Tuesday, April 2nd. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny and beautiful Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of Stockcharts. The Stockcharts platform was launched over 20 years ago to empower investors to better understand the markets using the language of technical analysis. I would argue there are times when this thing seems easy, things seems very straightforward, where things are working that make sense, things are not working that make sense. I don't know if this is one of those times. This is one of those times where previous leadership groups like technology, communication services, consumer discretionary, in a lot of ways, struggling quite a bit, right? The fact that Tesla, Apple consistently breaking through support here recently, bringing a lot of question marks into place. Semiconductors putting in weaker momentum readings, stocks like NVIDIA coming off of their all-time highs, still in good shape. So let's reflect on the fact that the markets are not too far off of all-time highs, but it's certainly having that rotational feel. It feels like things are a little bit different as we kick off Q2. We have a great guest today, by the way, Joe Rabil of Rabil Stock Research, highlighting some of the areas where he's seeing renewed strength and maybe some opportunity for all of us as well. With that in mind, let's get things kicked off with our market recap. I do want to start with a poll. This was actually a quiz we had going on our social media platforms, so make sure you follow us on all the socials. But I asked you, which candlestick formation is a classic reversal pattern found during market uptrends? The bullish engulfing, bearish engulfing, hammer, or bullish piercing line candles. How well do you know candlestick analysis? The correct answer is bearish engulfing pattern. What's interesting is the other three actually only happen in downtrends, right? So a bullish engulfing pattern, a hammer, a bullish piercing line, those patterns, part of a candlestick pattern is the trend leading into the pattern. That was one of the big things I learned when I was studying for the CMT exams years ago. By the way, if you want to learn more about candle patterns like the bearish engulfing pattern, you need to go to our chart school, which is a free portion of our website. But I will show you, I actually have a link here. Here's a good example of a bearish engulfing pattern. This is NVIDIA, kind of topical because we're talking about how NVIDIA is coming off here. One of the great indications in March was the sort of end of that first week in March, beginning of the second week. We had this bearish engulfing pattern for NVIDIA, which is a two-bar pattern during an uptrend where you have an up day and a down day. Day two, the body, the real body, which is the open to close range, so sort of the big rectangle part of the candlestick, that range engulfs day one's up day. Day one's open to close range. That's a bearish engulfing pattern. Usually suggests that whatever was happening leading up to that pattern is probably over. And if you look, that high, that intraday high around 970, we'll call it, so far the high for the year and the all-time high for NVIDIA. So after that pattern, there hasn't been any further upside. And that's why candle patterns like this, even if you're more of a medium-term, long-term investor, candle patterns pop up like that, I absolutely notice them and take and have a good awareness. By the way, look at the other bearish engulfing pattern as we retested those highs. That's why patterns like this and candlestick patterns in particular are very much worth your awareness. So go to Chart School, start searching for candle patterns. You'll find a lot of great examples to walk through. Continuing here with our market recap on the dashboard on Stockcharts.com, we have the S&P 500 closing just above 5205. That's down about 0.75% from Monday's close. The Nasdaq Composite and the Dow were both down about 1% for the day. Mid caps and small caps underperformed. The small cap S&P 600 down 1.7%. You know, yesterday, I think it was one of our 3 and 3 charts looking at the AD lines on different cap tiers, the large, mid, and small AD lines. And the large cap advanced decline line, the mid cap advanced decline line have both made new all-time highs in March. The only one that did not was the small cap S&P 600, and here we have another day where small caps are underperforming. So you really haven't had that resurgence in small caps to a degree that really implies optimism, I would say, so far. The weekly chart of the Russell 2000, by the way, the IWM, kind of pulling back into that breakout range. The VIX, the only thing in the green here, we did, I think, go briefly above 15. Yeah, out of the open, I saw that. Because I have an alert set, as I've mentioned many times, for a VIX over 15. That is my initial sort of basic, something's up kind of alert that goes to my phone and everywhere else. And the VIX did spike above 15 soon after the open. It did settle back down and did not end the day above 15. It was actually just below around 14.6. But let's keep an eye on an elevated VIX. VIX continues to go above 15. That is basically increasing the likelihood of a more significant pullback. I think we'll end up getting there. And, we didn't get much of a pullback in March. I would say that's probably just kicked the can down the road a little bit. And maybe April is when we had that drawdown many of us have been anticipating. Interest rates overall moving higher. You can see the 10-year Treasury yield finished today around 4.37. That's slightly above the 5-year point. The long bond yield finished today above 4.5%. We'll call it 4.51. Now, the short end of the curve, of course, is still higher. Now, this is more where the Fed is managing short-term rates as a way of affecting interest rate policy. And really, there's ripple effects across the curve based on what the Fed is going to do. The next Fed meeting, by the way, April 30th to May 1st. So we'll see what comes up there. Market not pricing in any change in rate policy, but certainly many will be hanging at the very least on Powell's comments, any official changes in the language around their official statement at the end of their two-day Fed governors meeting. Bond prices, of course, are moving lower when yields are going higher. So the TLT was down about 0.5%. The dollar index slightly lower from Monday's close. Precious metals all in the green. Silver was up 4.3% today. I know one of the things we'll talk about with Joe Rabil today are precious metals, gold, silver, and elsewhere. And today really continuing to follow through on that upswing we've been highlighting. The GLD was up about 1.5% today. Silver up 4.3%. So a nice leadership day for that area of the market. The commodity complex as a whole showing some strength, and crude oil prices about 1.4% higher from yesterday's close. Kind of red here on the crypto page. We have Bitcoin down over 5%, Ether prices down over 6%. I feel like since Bitcoin really pushed above 70,000, it's been a number of failed attempts to get a foothold, to gain some ground above 70,000. Every day we sort of finish up there, we sort of find a way to drift lower. Bitcoin's currently just above 66K, so that is down from yesterday. Ether prices as well. These are pretty big numbers if you're looking at a stock, but if you're looking at cryptos, it's not that unreasonable. It's a pretty volatile area of the market. Overall, the long-term trend on Bitcoin appears strong, but it's going into a bit of a consolidation pattern, what we call a coil pattern. We'll get to that chart here a little later in the recap. Time permitting. Looking at the 11 S&P sectors, only 2 out of 11 in the green. So from a sector breadth standpoint, for lack of a better term, not particularly strong today. Energy, though, doing just fine with the XLE up 1.4%. You can see utilities finished slightly higher. What's interesting about that is with utilities slightly higher and the S&P down, the relative strength of utilities is really starting to push higher. And while I tend to think of the defensive sectors as a group, right, it's utilities, consumer staples, and real estate. If you look at the last 6 weeks, utilities outperforming, consumer staples in line with the market, real estate underperforming. So you're actually getting a bit of a divergence there. Utilities are the one that I tend to follow the most in terms of a macro call. So keep an eye on utilities up at the top of the leaderboard. That would suggest further outperformance. On the bottom, you had a couple that really gave back some of the recent gains here. Healthcare continuing to struggle. The chart of the XLV does not look particularly good here. We'll highlight, if time permitting, some of the healthcare names really leading the way lower, but the XLV was down 1.6% today. Consumer discretionary down 1.5%. That's really dominated by 3 stocks, Tesla, Amazon, and Home Depot. Tesla, of course, continuing to show a weakness. The worst of the, I guess, quote-unquote Magnificent Seven. I think we're probably done with that label by now. Fab Four was one I've heard floated around. The real estate sector, third from the bottom, down 1.1%. Let's focus on that group of mega cap leadership names. Meta, the only one of the bunch that was actually up today, finishing up about 1.25%. Netflix and Amazon were essentially flat. On the downside, you have Tesla really dropping it after struggling and certainly underperforming the rest of this group, down almost another 5% today. NVIDIA down 1% as well. I think NVIDIA might be the most important one to watch of all of them. Tesla's kind of already done. Apple has certainly been struggling, facing huge regulatory pressures. But NVIDIA and semiconductors have been so strong for so long. This market struggles, I would argue, if semiconductors start to retrace some of those previous gains. And we're really starting to see that rotation lower here recently. Let's go to a daily chart of the S&P 500 and see what happened today from the perspective of the daily chart. You can see the Apple alert that I had set. And again, I can't stress enough, one of the great benefits of using a platform like Stockcharts and letting it do some of the work for you. It's really hard, and I know from doing a show every day, it's really hard to keep on top of everything happening in the markets. Using our scanning engine and using our alerts functionality, the platform will do the work for you. So I got a trigger right out of the open. My cell phone lit up saying Apple had crossed below my level of support that I'd laid out there. So make sure you're using our alert functions if you have not done so yet. Here's the chart of the S&P 500 going back for the last, we'll call it year and a half or so. You can see, of course, the clear pattern of higher highs and higher lows. Now, what I like to do when a chart is in an uptrend like this are just define those, what I call lines in the sand, right? That level or those levels that are of interest to you. And you can keep updating those, right? So as long as the trend continues, you can keep bumping up those levels of support. And most recently, this what I call a tactical support level, because it's just looking at the last couple of weeks, right around 5,200. So we sort of broke above that level here. That's one of the most sort of recent push to new all-time highs was a couple weeks ago, third week in March, as we closed above 5,200 for the first time. We went higher one day, and that's basically your high for the year so far. We traded a little bit lower down to 5,200 before retesting the highs. So on that tactical time frame, you're really sort of playing around those levels, and I'll zoom in just so you can see what I mean here. This is the zoomed in version of that chart, just showing this, sort of breakout, the retest, then the retest of the previous highs, and now we're right back at the lows. This pattern right here, by the way, can you call out this candle pattern, right? This is one we've talked about before, not often, but often enough you may remember it. This is actually called a dragonfly doji. There's testing your knowledge, deep knowledge of candle patterns. A doji candle is when the open and close are right at the same levels. If the open and close are at the lows, it's called a gravestone doji. That's one of them right there on the chart of the S&P. When the open and close are near the highs of the day and you have a long lower shadow, that's called a dragonfly doji. It does suggest short-term upside from that pattern with a natural sort of built-in stop at the low of today's trading. But overall, I mean, certainly showing some top heaviness here as a lot of the leading names have started to struggle a little bit. But I would say this is not a broken level of support. I would say this is a tested level of support. So when we open above a level, we trade below it, but close back above it. That's actually suggesting that support is holding. Market's kind of doing what you'd expect at that particular point. Now, going back to the daily chart of the S&P, just to sort of show how things have evolved, what would happen if through the course of this week we do break below that level? For me, then we immediately go down to the next support levels. We could also use things like Fibonacci retracements, which I'll try to circle back to. I think one of the 3-and-3 charts hits on some of those levels, but I'm keying in on that 50-50 level, which means for me, we've got another 150 points below today's close. And as long as we hold that on pullbacks, as long as we hold an ascending 50-day moving average, this market's not doing too bad at all. Now, I also want to point out with the Fibonacci retracements, I sort of highlighted some of the different relationships here. This is a chart that I have on a chart list that I review all the time, and it's just meant to think about the Fibonacci framework and just reflect on any time I feel like we have a major high or a major low. I like to throw these retracements on, and what I'm looking for in particular is when you get some agreement between some of these different levels. So one of the things that I'm noticing is if we would sell off from here, and I'm saying we get an even further drawdown below 50-50, and all of a sudden we're all very clearly recognizing that the market is in a retracement period. 38.2% of the way down from the October 23 low to the highs that we've experienced here in the last couple weeks, 38.2% of the way down will be right around 48.16. We'll call it 48.15. If you look to the left on your chart, that was your previous all-time high from the end of 2021. So interesting to me that the first Fibonacci level lines up with a level that sticks out big time on your weekly chart. I'm wondering if that's sort of the natural downside objective to this run, if we would get some weakness in the second quarter. So if we do get further pullbacks, I think I have a sense of where I would sort of identify some potential first downside targets. But first things first, S&P above 50-50 is still fine, and that certainly seems to be what I would how I would describe the current market environment. You know, I did my monthly chart review with my Market Misbehavior Premium members earlier today. It's a webcast that we do together, a discussion of some of the longer-term trends. One of the charts we looked at was a version of this chart, looking at what I call the newer Dow theory. This is looking at the S&P 500 in the top panel, the Nasdaq 100 in the bottom panel, but instead of using the regular cap-weighted ETFs, I'm using the equal-weighted ETFs. So RSP is an equal-weighted S&P 500 ETF, and QQQE is the equal-weighted Qs. Now, one of the things I wanted to point out to you is just this divergence. Really not much of a divergence, but I would say it's a non-confirmation. What a non-confirmation is you have two series, in this case the S&P and the Nasdaq, one of them clearly breaking out, one of them clearly not. Note how in the month of April, the equal-weighted S&P did make a new all-time high in the last week. That was last week. And you can see that the Nasdaq 100 actually did not make a new high. It's more sideways than anything. So a potential non-confirmation here with the S&P breaking out, the Nasdaq not doing so. These start to pull back. A sell signal on this chart would be both of them breaking support, which means you'd have to have further deterioration on both counts. But for now, it's certainly not a bullish exclamation point. A bullish confirmed pattern is both of them breaking out. Early February is a good example of that. That's not what we're seeing here as we kick off Q2, which is a bit of a concern in my book. The VIX, as I mentioned, popping above 15 briefly, but it did close back below that 15 level. I'm always watching that 15 point to see if we close above there or not. We traded above it, but did not close above. We actually finished below that 15 threshold. So if we would get above there through the remainder of this week into next week, certainly could be a potential cause for concern. Here's the Nasdaq 100's bullish percent index. I just wanted to highlight this one briefly because we're right at 50%. So that means it's a crapshoot. It's a coin flip. If you pick a random stock within the Nasdaq 100, half of them are in a bullish point and figure configuration, half of them are not. And that's the problem because at the end of last year, it was around 85, 90% of this group of 100 leading growth names that were in a bullish signal, which means about 40% of the Nasdaq 100 have given a sell signal from around the last week or so of 2023. That's a big shift, and that shows you how many leading growth names have been struggling. Now, the S&P's bullish percent index is still above 70%, while the Nasdaq's is down at 50%. So really speaks to the different experience from growth versus value as we've progressed through Q1 and now beginning into the second quarter. I want to look at a couple charts here just to finish off our recap. Let's talk about two sectors in particular. One would be healthcare. And if you look, the XLV features a pattern that I would say many individual stocks do, and not just healthcare names. I'm going to switch this from a bar chart to a line chart. And the only reason I'm doing that is because it's just a little easier to see this divergence that I'm going to highlight for you. So a bearish momentum divergence, and one of the first items on my bull market top checklist is you see a proliferation of bearish momentum divergences. I would say the XLV is a perfect example of that. Higher highs February into late March, lower peaks in momentum. We're overbought in the late February peak. We are not overbought in the late March peak. So higher prices on weaker momentum is a sign of upside exhaustion, and that's basically what you're seeing on the chart of the healthcare sector. Clearly underperforming as well. Now, what you've seen is the relative strength has waned on things like technology and consumer discretionary. It's really exploded on the sector we're going to look at in a second, energy, but also other things like materials and industrials and financials. But it's certainly not been great on healthcare. And I would say as a sector, while it's pulled back a little bit, you're certainly seeing some weakening momentum characteristics, testing that 50-day, by the way, on the XLV. MOH is Molina Healthcare. This is one of the names I'd highlight within the healthcare sector. It's one of the biggest drops in the S&P today, down almost 6%. It was down more than that, actually rallied a little bit going into the close. What's interesting about what happened today, again, we made a new high just above 420 less than a week ago. We gapped lower today after a couple days going down, and today's close was below the 50-day moving average. Now, two things I would point out here. Number one, we ended the day right at that February low, right? That February swing low is right at 380. We gapped below there, but actually closed right at that point. So I would say we are literally testing that support right now. Also notice we had a number of pullbacks below the 50-day moving average, and basically the day we've moved down, we haven't gone much further, right? That's usually been where things consolidate before a recovery and a return back to the upswing. That's what I would be looking for optimistically if I hold a name like this and I'm not stopped out yet, to see if buyers start to come in and if we get a repeat of that sort of last week in January kind of effect. But if we go much lower than this, particularly if we close below that February low, that is a breakdown name in a big way. Tesla, of course, continuing to go down. I would say the trend on Tesla, the primary trend, certainly seems weaker with a clear pattern of lower highs and lower lows. Today we gapped lower but closed higher. testing support around 160. That's where I have an alert. I would encourage you to do the same. And also keep a wary eye on semiconductors. NVIDIA, one of the worst performers within that Magnificent Seven group of stocks. The semiconductor ETF still good. Primary trend, I would argue, is still positive. But you had that bearish engulfing pattern in early March, just like NVIDIA and other charts did. We've struggled to regain that high and to regain a foothold above the previous high around 240. That's it for our market recap, folks. I want to make a couple quick announcements before we bring on today's guest, Joe Rabil. First off, we would love to hear from you. We're going to do an all mailbag episode on Friday of this week. We'd love to answer one of your questions as part of that episode. You can email us any questions about technical analysis, market history, investor psychology, market dynamics, whatever it is. We're here to help point you in the right direction. TheFinalBar@Stockcharts.com is our email. On X, just tag us in a comment at FinalBarSCTV. And on the YouTube, just put a comment below the video that you're watching. We would love to hear from you. We'll hope to answer your question in our next mailbag episode. I'm going to be speaking at the Money Show Investment Masters Symposium. This is coming up May 7th through 9th. It is an in-person event in Silicon Valley, California, so right in the Bay Area. I'm going to be doing two events, a workshop, I think, on day one, and then day 2 or 3, I'll be doing a 2-hour masterclass called 7 Questions to Ask Before Every Trade. This is a particular event focused on self-directed investors, high net worth individuals getting together and talking with some of the top minds, hopefully, and also me in the investment community. But I look forward to sharing some ideas with you. Just scan the QR code to get more information and to sign up for the event. We also have a link in our description, so click that if that's easier as well. I want to welcome on today's guest, Joe Rabil. Joe's the president of Rabil Stock Research, coming to us from Fairfax, Virginia. Joe, welcome back to the show. How have you been?
Great. Thanks for having me on.
No, it's a pleasure. We just wrapped Q1. We're now starting Q2. I would say a rocky start maybe to get things kicked off here in April. But I mean, take a step back for us as you sort of look back and reflect on the first quarter and now looking forward to Q2. What stands out to you? What are those key themes you're sort of paying attention to these days?
Well, it's kind of like what we're going to talk about today in terms of the charts that I'm bringing up. One is the fact that growth has been killing value, like killing it to a pretty significant degree for a pretty extended period. And we're starting to see signs that the relative strength might be starting to tick down on some of these growth stocks. So I think the question becomes, is that the end of those stocks, which I don't believe it is, or is it kind of like a breather? And if that's the case, then what other areas can benefit? And so, we're going to talk about some that have definitely been benefiting, and we'll talk about how far they can go, I think. So I think that's kind of the key thing I'm watching right now.
I will tell you, Joe, having had a number of guests coming through the Final Bar regularly, you have probably the most well-designed narrative with some beautiful chart work. So I want to get to the charts and kind of talk through it. You sort of alluded to this, right? Sort of this rotation a bit away from growth and into value. We're looking at the QQQ, and these are your ACP charts that we're looking at. So the upper left, we have the weekly chart, then we have a daily, weekly, monthly kind of going around the circle here. What stands out to you looking at the Qs, and particularly the relative to the S&P, right?
Yeah, so in the upper left, I've got the relative strength line, that black line there in the middle scale. That has been, it's been up. I mean, not as strong as it was, starting late last year, it kind of started to flatten out. But now it's actually starting to come down through the 30-period moving average that I've got there. Little disturbing. Now, I like to think about relative strength as reflective of what I'm seeing in terms of overall technical analysis. So if we look at what led to this, I think, you've got a month. Let's go back and look at the 4 charts. We've got the monthly chart on the bottom left, which has gotten really far away after 5 or 6 months to the upside. It's gotten kind of far away from support. The weekly kind of did the same thing. That's over on the right. That's made kind of a bit of a run. It's gotten stretched away from its 18-week moving average. Now, both of those have decent momentum conditions in place. But if we go up to the daily chart, which is the upper right, let's zoom in on this one. Notice what took place here. It was strong momentum. If you look at the ADX, all right, the ADX has been strong going back pretty much up until really the start of March. If you look at where March started, it started to fail at that 25 line. So I've got a 25 line going across in gray.
Yep.
And that was the first spot there. Late in the year, it dropped down, right? Late in February, it dropped down below, but then we popped up and tried to get back above 25 in early March and couldn't do it. Now is when price was going to a new high. So to me, this is really, the momentum has really died off here on the daily time frame, and I think that means that we should be ready for some kind of a correction. Now, I'm waiting for the 40-day moving average. That's the line it keeps bouncing off of. I think if we break that, then we probably are going to go through a deeper correction that you'll be able to see on a weekly chart at least.
It's interesting. We've highlighted the bearish divergence with the RSI, right? The Qs are going higher, the momentum sloping downward. You have the MACD indicator, same thing, right? And we're making new highs. These indicators are trending downwards. It's an interesting discrepancy. So if the growth stuff is starting to lag a little bit, where does the opportunity lie these days?
Yeah. So, well, let's look at, I mean, I think the commodities, generally speaking, I would just call it a commodity move, because we can look at gold, silver, we can look at oil, we can look at copper. Really, it's almost most commodities except the ag area. Ags really aren't doing anything, but most commodities are actually playing pretty well. But look at this gold breakout. And it was actually confirmed on a monthly basis with that monster green bar breakout. It closed the month right near the high. I love to see a big green bar like that on a breakout bar.
Yeah.
So that's really encouraging. We're starting to see the momentum kick in on these. But I think talking about silver is actually pretty important, because we see a big base in gold. I mean, that's a 3 to 4 year sideways consolidation. But and we were talking about before the show is that a lot of times gold can make a decent move, but it's sort of rare for it to make a really substantial extended run without silver really confirming. And today, I would say we're getting that confirmation finally in silver. A low ADX condition on the monthly and low ADX condition on the weekly has been doing nothing, but look at the ADX on the daily chart starting to really kick in over the last month. It's breaking above 25, showing a lot of strength in this move. And today we're breaking out above some pretty good resistance. So I'm pretty encouraged by that, actually.
This is very interesting. It's almost the opposite of what we saw with the QQQ, right? You sort of have the weaker ADX on the monthly, the weekly, stronger, showing that improvement on the daily, and agreed. Both gold and silver now breaking to new highs. Copper have a similar feel to it, or how does this relate?
Yeah, I mean, this has been really, really quiet. It's just been walking sideways, kind of doing nothing, and now it's just starting to emerge. And again, we always see the momentum on an ADX basis showing up on a small time frame first. So I'm always, Dave, one of the things I like to do is look at the big time frames and look for low ADX on a monthly and a weekly. And we've got low ADX, extended period low ADX for copper on both of those time frames. And then I look for the daily to kind of say, okay, it's starting to get going. And we've got enough strength here and it pulled back and held this 25 support, and now it's turning back up. So I'm pretty encouraged by what's going on there, but it's even more encouraging when you start to look at some of the stocks, the FCXs and SCCO. I mean, they're just powerful breakout patterns. So pretty encouraging.
Let's talk about some of the sectors that are really coming alive with this commodity run that we're starting to observe. Energy, for sure, starting to show renewed strength. And this is after, energy probably, I think a lot of people still thinking of it as an underperformer because previous cycle is really sort of struggling while growth stocks were working. It's a completely different year now with 2024 pretty strong, particularly the last 6 to 8 weeks, right?
Yeah, definitely. But if you look at the big picture, if you look at that monthly chart, to me, I've been saying the same thing, that this is a correction in an ongoing long-term trend. It wasn't a reversal of the trend. And it's a benefit of using these longer term charts. You recognize what's going on. Like, yeah, there was weakness into the end of the year, but it wasn't a reversal to the downside. It was something that we should be expecting that was going to, come back at some time early this year. So we're seeing it, we're seeing it with real strength now. Pretty impressive, really.
Another one of those big green candles on the breakout, similar to an earlier chart as well. Materials, another sector, it almost feels on the longer term chart, kind of early on emerging from that base on the monthly, right?
Yeah. And I mean, that's just it. Like, I love these MACD patterns where they on the monthly chart, where they spend all this time coming down towards the zero line. And I call this a flyby because it doesn't actually come all the way down and touch the zero line, but it kind of flies by there. Now we're turning back up. I mean, it's a pretty substantial reversal on a huge chart. So it's hard to ignore that. And again, a lot of the commodity-based stocks are in this sector, and we're seeing them, we're seeing them break out. So pretty good pattern, really good momentum taking place on both the daily and the weekly now on this sector.
Two individual stocks you've selected from these two sectors. Let's start with Freeport-McMoRan, FCX. A good idea here, yes or no, and why?
Yeah, I mean, here's a copper pattern. Now look at the MACD on the monthly. You see how this does another sort of similar flyby, but it has this ADX pattern where it was really strong into the highs before it started the correction, and now it's come all the way down, and it's a low ADX pattern as this is starting to break out again. So it's a really nice combination, and I'm looking at a monthly chart here, so I don't think this is a small move. The other thing that's important on this one, Dave, is that it's an inside year last year. Last year was inside of 22. So it's always important to see any stock that's breaking above, the highs of an inside year, and that's what's been happening here over the last few weeks.
That's a really interesting observation, Joe. So to be clear, what you're saying, here's 2022, you have this wide range. Last year, lower high, higher low, sort of compressing the range, and that means this breakout a little more meaningful. Is that right?
Yeah, and look at the size of that green bar.
Yeah.
That's where everybody's kind of in agreement, I mean, that's what I want to see on a breakout pattern. So
for sure, impressive move, and even in the short term, we're seeing on the weekly chart as well, breaking higher. Energy stocks, certainly we're seeing them, starting to be on the new highs list a little more than we have been recently. Suncor Energy, a good opportunity here.
Yeah, I mean, look at this. It's been doing nothing, and now it's starting to emerge. We've got momentum kicking in. Same thing going on with this MACD monthly. You see how it's just, it made a peak a few years ago, and now it's starting to cup around after going sideways and staying above the zero line, and we have a low ADX pattern as well. Yeah. So it's the type of thing where I think as these start to emerge, and this is just one example, there's a lot that's going on like this in energy right now. That look attractive, starting to emerge. And, obviously on both of those stocks, probably like to see a little bit of a pullback if we can. But on gold stocks, you got to be a little careful about being too picky once they get going. It's a lot of times it's hard to get a really good entry. You could just miss it altogether.
We only have about a minute left, Joe, but I'd love to ask on Suncor as a great example here. You're highlighting some of these areas, really starting to emerge from, multi-year basis in some cases. How do you manage risk on a name like Suncor? You mentioned a potential pullback. How do you differentiate a short-term, very viable pullback from something more painful, I need to get out of the way kind of pullback? How do you think about that with a name like Suncor really, looking stronger here?
So what I like to do and what I recommend to my subscribers is I tell them, look, you want to give it enough room based on normalized volatility. So I look at average true range, and I normally want to give it at least 2 times that and I go by the time frame that I'm using. So if I enter off a weekly chart, I'm looking at it as a bigger picture play, then I want to use 2 times the weekly average true range, not the daily. Right. And that's going to give it a lot more room so that you can handle some of the volatility, which we definitely have some volatility in these stocks. So that's kind of how I would recommend it. If you want to play it off the daily, you can do the same thing, but you gotta recognize that you're playing it much tighter using an average true range that way.
Yeah, this has been fantastic, Joe, and I really appreciate this mini masterclass in thinking about multiple timeframes and how to do that very nimbly through the ACP platform. Good to see you, Joe. Thanks again for coming on, and we'll look forward to talking to you again soon.
Thanks, Dave. Enjoyed it.
That's Joe Rabil. Joe's the president of Rabil Stock Research. There are so many little, great points that Joe made in there, to be honest with you. That whole idea of that flyby pattern, I think he called it, which is the MACD, the weekly, monthly MACD in particular we were looking at, coming down, hooking higher, giving a buy signal above the zero line. We saw that as a consistent pattern on some of these charts. He was highlighting also the big green bar, right? That big up period as we break out of a base. It's a great way of thinking. I'm reminded of someone like William O'Neill, who spent so much time looking back at what had worked and then looking for repeatable patterns. And I pick up some of that same insight from Joe pointing out some of these winning patterns on the monthly, the weekly, even the daily charts. Great take there, as always, by Joe Rabil of Rabil Stock Research. We got to wrap the show, folks, and go right to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. In our market recap, we talked about the Fibonacci retracements for the S&P 500, and I cleaned up this chart, spent some time before the show to show you what I mean when I talk about aligning different levels, right? So step one is when you have a big move. So I'm taking the S&P from the October 23 low and then connecting that to the highs we've experienced here in the last couple weeks, just about 42.60. 38.2% of the way down is right here, right around 48.17. The levels might be a little different depending on exactly where you put those lines, but I don't think of things as too precise. The general level is what I'm looking at. But once I set that framework, once I identify that 38.2% level, make this horizontal line, and look how it lines up almost perfectly with that high from the end of 21, peak of January 22. When you have different frameworks, different methodologies, and they end up keying in on a same particular level, that's when it feels like this market kind of makes sense. It has a rhythm, it has a symmetry. So I would say if we do start to break through some of those initial support levels, those lines in the sand that I've mentioned, 50-50 for me is that main cutoff. That would immediately, for me, initiate a downside target, a minimum downside objective around 48.15, which would take us down to that first Fibonacci support level and also eventually be a retest, or essentially be a retest of that 2022 high. Chart number 2, energy. I love Joe Rabil's take on energy and materials. Would wholeheartedly agree with his focus on a rotation away from growth leadership, really into value leadership. And it's not really defensive sectors. It's into things like energy, materials. We didn't mention industrials, but I would also put those in the list of leadership sectors as well. Financials probably at the same point. The chart of energy, and here I'm using the unadjusted data. So we're looking at the raw data set going back. Look at the high from mid-22, from late 22, from the fall of 23, and we've just broken above that level. So these are monster bases that these sectors and a lot of these charts are breaking out of. The weekly PPO, pretty bullish, and I would say overall, charts like this, innocent until proven guilty, particularly when you break out of a significant base like we've seen with the energy sector. Finally, the chart of Bitcoin. We didn't get to this in our market recap, but I did want to highlight, and sorry for the incredible number of lines here, but I was just trying to highlight a couple different things to think about. This is that what I would probably describe as a potential pennant pattern or a coil pattern. A coil pattern is where you have a big move, and then you have this consolidation of lower highs and higher lows. The reason why I call it a potential pattern is because this is today's bar, which is still active, because this trades 24 hours. So hard to tell what that lower boundary is going to be. So I'm estimating we don't get much lower before we bounce up a little bit. That might be a big assumption, but I would say if we do get a higher low right around these current levels, that would make a clear coil pattern. What happens with a coil pattern is one of the two things is going to happen. You either break above the upper boundary or break below the lower boundary. And if we do so, look at how the swing low of this pattern lines up with a 38.2% retracement of the 2024 range from the January low to the March high. So identifying a bit of an overlap there. If we would break that level, and that's right around 60K, next downside objective could be around 52,000, and that is the 61.8% retracement. It's also a 38.2% retracement to the last major low off the viewable area, all kind of coalescing around that level just above 50K. So using some of these frameworks on different charts on different time frames can help you sort of identify where you have a sort of a confluence of support, as I like to describe it. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to Joe Rabil of Rabil Stock Research joining us from Fairfax, Virginia. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.